Good morning! Welcome to Feasibility Study Module 4, Financial and Sensitivity Risk Aspect of Feasibility Study. Aspect. Part of what you need to do when you want to conduct financial analysis for your business is to draw up a comprehensive budget for your business. Your budget should capture your expenses and your income and also the financial flow strategy. The truth is that bulk of the job will be done here. It will be done on your budgeting. When conducting financial aspect, it is important that you know your financial capacity. The bottom line is that economic analysis revolves around managing the scarce resources within your disposal, and finance is the chief of the resources. Everything concerning finance should be dealt with at this occasion. If you are trying to raise venture capital for your small business startup, then you have to do a clean job on the financial section of the feasibility study report, because this is where investors focus on. All they are interested in knowing is how much is the percentage return on investment and the payback period. What is financial analysis? Financial analysis will be dealing with the estimation of the total capital involved, capital expenditure, working capital, profit and loss analysis, pricing of products, cash flow projection, projected sales, revenue, and the entire project viability. Financial feasibility will involve total project cost, initial capital requirements, sources of financing, financial statement, and financial analysis, which more on confirming the overall firm liquidity, the degree of indebtedness, and profitability. Total project cost is also called cost estimate. It is used to authorize a project's budget and manage its costs. Professional estimators use defined techniques to create cost estimates that are used to assess the financial feasibility of projects, to budget for project costs, and to monitor project spending. Capital requirement is the sum of funds that your company needs to achieve its goals. Plainly speaking, how much money do you need until your business is up and running? You can calculate the capital requirements by adding founding expenses, investment, and startup costs together. Sources of finance for business are equity, debt, debentures, retained earnings, term loans, working capital loans, letter of credit, euro issues, venture fundings, etc. These sources of funds are used in different situations. They are classified based on time period, ownership and control, and their source of generation. Financial statements are formal records of financial activities and position of the business, person, or other entity. Relevant financial information is presented in a structured manner and in form which is easily to understand. An example are balance sheet or statement of financial condition, income statement or statement of operation, cash flow, notes to financial statement, etc. Financial analysis refers to an assessment of the viability, stability, and profitability of the business, sub-business, or project. It is performed by professionals who prepare reports using ratios and other techniques that make use of information taken from financial statement and other reports. Example of overall firm liquidity is current asset ratio. Current asset ratio is computed by means of dividing the current asset over current liabilities. The result should be at least 1.2, or the 1 for the payment of all liabilities, and the remaining 20 cents for every peso will be used for the operation of the business. A current asset ratio is also known as working capital ratio. Your business are liquid when you have immediate cash flow that can be used immediately. Example of degree of indebtedness is the debt ratio. Debt ratio is computed by means of dividing the total liabilities over total asset. The result should have at least 40% or less on the total asset. Profitability analysis is divided among return on sales, return on equity, and return on investment. So let's start with the return on sales. Return on sales is computed by means of dividing the net profit over sales. It is also called as profitability ratio. The result should be at least 15% or more to make it profitable. Number 2 example of profitability is the return on equity. It is divided by means of dividing the net profit over capital. Here, it determines the percentage or share of income against the ending capital. It doesn't matter how many percent as long as it has a positive percentage. But it assumes that having a 15% share on capital or more means a more profitable business. Number 3, number 3 sample on the profitability analysis is the return on investment. It is divided by means of getting the net profit over asset. Here, it determines how many percentage of net income over total asset. Remember, it must be with positive percentage. Sensitivity and risk aspects of feasibility study. This is the last part of feasibility study and probably the most important. After all other factors have been analyzed and proven viable, sensitivity and risk analysis can come in. Building a business without properly conducting a risk analysis is like flying a plane without regards with weather condition. Here, you need to discuss the pros and cons of the business. Under risk aspect, the sensitivity to competition should be determined in the liquidation rate of companies in the industry of your proposed business venture should be calculated. With result obtained from sensitivity and risk analysis, growth and survival strategies can be developed to your proposed business. That's the end of your Module 4 Financial and Sensitivity Risk Aspect of Feasibility Study.